Okay, those are the headlines that we are tracking for you this evening on ET Now. Well, let me welcome our very first guest on the show. Mr. Harish Roongta joins in. Hi, Mr. Roongta. Good evening and a pleasure having you with us. So, for a very long time, we have seen most mutual fund investors in the small and the mid-cap space, especially the ones who invested in the last 3-4 years, being extremely disappointed because they've not really done much. We've got so many viewer queries as well, many of which you yourself have addressed about how a small cap fund has not done well and it's really just moved sideways for the most part of the investment duration. Now we are seeing better performance than even large caps after a gap of 4 to 5 years. What's your view of this trend? Is this something that's usually seen where there'll be a few years of outperformance and then a few years of underperformance? Is this a regular cycle that we usually see small caps and mid caps follow?
Oh, absolutely. I think these are all market cycles, and at some points of time, large caps will do well. Some points of time, small caps will do well. Some points of time, some particular segment will do well. Particular segments won't do well, and relative performance of each segment would be different. Uh, According to me, it's unpredictable. Nobody can predict what's going to happen. Is there juice left? I have no clue. Okay, and I don't think that's how investors should look at it. Any investment in equity, and definitely in mid caps and small caps, needs to be for pretty long tenures. It needs to be like 8 to 10 years at the very minimum. And during that period, you're bound to have times when it will outshine, other segments, and there are bound to be periods during which it will underperform. And I think there is no need to feel happy when it outperforms. There is no need to feel sad when it underperforms. As long as you clear what you had invested for and you had followed a proper asset allocation strategy. So I would not go overweight on small cap because small cap has done well. Okay, or I would not go underweight on small cap because it hadn't done well earlier. I think your overall asset allocation strategy cannot be driven by performance. It has to be driven by your goal, how long it is, what is your risk profile, what kind of resources you have, and how do you want to spread it. So you will first, it's always a top-down approach. It's never a bottoms-up approach. This thing about an X scheme or a Y scheme is very bottoms-up driven. I think it needs to be top-down. What's your goal? What's your tenure? What's your risk profile? What kind of resources you have? Once you have that, you decide how much money in equity, debt, international equity, gold, maybe real estate. Then within equity, you can look at large cap, mid cap, small cap, based on a certain strategy. Then comes, once you have decided the allocation to mid and small cap, then comes which scheme in mid cap and small cap. So, it's at the bottom end of the decision making cycle. Unfortunately, we tend to make it right at the top.
So basically, Mr. Roongta, once a plan has been put in place, a well thought of plan of how you want to allocate your assets between large caps, mid caps, small caps, don't tweak with it regardless what the markets are doing. What about those individuals who've not yet made a plan and are obviously looking at the market rally and they want to start off now? Any time, of course, is a good time to start off, but still they'll think that, mid caps have run up so much and small caps have run up so much. Does timing matter then? Entry point matter?
So I don't think anybody can get timing right 100% of the time. I mean, it's like tossing a coin. So I would not recommend timing, and definitely not in such volatile asset class like mid and small cap. In fact, in any volatile asset class, any kind of equity, but definitely mid and small cap, definitely not, because please remember, unlike large cap, in mid and small cap, when lots of people rush in to buy, the price rise disproportionately, unlike large caps. When large number of people go to sell, price drops disproportionately. So I think that's called impact cost. And I think impact cost is extremely high in small caps. It's also high in mid caps. And therefore, one needs to be very careful in not trying to time it. I don't think it is timeable. So if you don't have a plan, my advice is go make a plan.
Okay. Now, we've seen, we obviously, volatility is literally the middle name of equity markets, and one must be aware of that. However, still, within varying classes of, equity investment strategies, there is varying differences of volatility. Do you believe that, a mid-cap, small-cap fund is a must-have in every portfolio, or do you think that perhaps there's one category of investors who should either limit their investments in mid and small cap funds or keep it simply zero?
So again, it's very difficult to have a general rule without knowing the specific circumstances. So let's pick a case where you should have. Okay, so let's pick a case where the goal is still good 8-10 years away. The resources are not very short. The risk profile is at least on a scale of 1 to 5, it's at least 4, which is moderately aggressive. Resources are reasonably there. Then definitely there is an allocation to mid and small cap you should have. Now, how you will take it is a completely different kettle of fish, but definitely in a scenario where the tenure is 8-10 years away at least, risk profile is at least a 4 on a 5-point scale, moderately aggressive. Resources are reasonable. I mean, they are the reasonably required for the goal, so that the assumption on return is not very high. In such a case, definitely there should be some allocation. Now, whether that should be 10%, 20%, so there should be some allocation to equity. Of that, a certain portion should be to small and mid cap. And the proportion can be different depending on how you put it together. So if you put it together as a part of a larger fund, then there is some self-balancing happening. So you could probably take a larger exposure, etc. So it then depends on the technique. But I think if these three conditions, risk profile 4 or higher, goal 10 plus, reasonable resources, I think it calls for some allocation to small and mid cap.
Okay. Well, I think that's fairly explained, Mr. Roongta, and I suppose it's a good, it sort of has very, I'm sure that a lot of investors who are listening right now will very well be aware of how exactly one should go about when it comes to investing in mid and small cap funds. Now, how do you, review the performance of your funds? Because the index has returned what, 80%, 90%, 70%. What if your fund has not done as much? Would should viewers and unit holders be disappointed? What's the right way of reviewing a fund performance?
So I presume you are meaning an active small cap or a mid cap fund as relative to the index that whatever is the benchmark. If it is the mid cap, it will be the mid cap 150. If it is the small cap, it will be the small cap 250. That will be the benchmark. I think in this, the active funds are quite, a lot of active funds are there and some of them have done really well. But again, you will see there will always be periods when you are trying to score over the benchmark, there will always be periods during which you are under because you are following a strategy. If you want to get the benchmark returns, invest in an index fund. Obviously, when you try to get returns which are much higher than benchmark, you have to be reconciled to periods during which it will be lower than benchmark. and you have to give it adequate time. So I think the performance should always be seen relative to the index. It should not be 1 point to 1 point, neither should it be 1 year according to me. If at all you want to even look at relative performance relative to the benchmark, I would look at a 3 year daily rolling average returns over the benchmark over the last 5 years. I think that sort of will iron out the wrinkles. It will give it enough time for any positive strategy to kick in. So I think looking at a 1 year from one day to another day and saying that, oh, this has underperformed the benchmark would be the wrong way to look at any fund.
Okay, well, I think let's do one thing. Let's take on board some questions and queries then. Remember, folks, you can connect with us on our email address, themoneyshow@etnow.tv. Our very first question then is from Tyagarajan. He says his question is on avoiding over diversification of mutual funds. He himself has invested in mid-cap funds of 6 AMCs: Axis, DSP, Kotak, PGIM, SBI, UTI. But now he realizes the need to reduce them. He says he wants to reduce it to 2. He also says that he looked for any sort of portfolio overlap, but it was around 20 to 30%. So he's asking, what's the best systematic approach to reduce the number of schemes in the portfolios? I think this is a very valid question, a very good one as well, because usually when you pick up too many funds, there will be some or the other overlap. Do you see that happen in mid and small cap funds as well? Because, our viewer seems to have done a bit of his homework, and he says even though he has 6 mid cap funds, the overlap is only 20 to 30%. But still, do you think that's way too many funds? Because each fund invests in almost 70 to 80 stocks.
Oh, absolutely. So I can't really see. One needs to look at his stocks and see how it. Please remember, the mid-cap universe is 150 stocks, right? So how it can only be 20-30%, I find that a little difficult to understand. So two things. I think the best way to do mid-cap investment for most investors is pick up a mid-cap index fund. Okay, that gives you diversification, and that's just one scheme. In fact, there are only 2 fund houses that offer a mid-cap index fund. One is Nippon and another is Motilal Oswal, or small cap for that matter. I mean, that is also again Motilal and Nippon. The advantage of an index fund is that it gives you the spread without it comes at a low cost because it's a passive fund. It comes at a low cost, obviously, because the risk is relatively lower. Therefore, the return would probably be relatively lower as compared to, say, a more active mid cap or a small cap fund. In the mid cap and small cap space, mutual funds, other than the index funds that I spoke about, have a real problem. And the real problem is this: even though you yourself as an investor might have a 10-year horizon and therefore not panic when the market drops, the problem is that other people might panic when the market drops. And in the mutual fund scheme of things, the fund manager is forced to liquidate good stock, which forces prices down more because mid cap and small caps have so less liquidity. And therefore, even despite you sticking around, you suffer because of the other people panicking whilst you don't. That is why I think if your portfolio size allows it, mid cap and small cap exposure is best. You are anyways taking a risk. So if you're taking a risk with that part of your portfolio, do a PMS with a good PMS provider who does mid and small cap. The main thing, of course, there is that PMS means minimum of 50 lakhs. You can't do lower than that. So if your portfolio allows you to take an exposure of 50 lakhs to mid and small cap, PMS is probably a better route, or stick to a mid cap or a small cap index fund.
Understood. Oh, okay. All right. Well, let's take on board one more question. Mr. S.B. Sivakumar has written in saying the market's constantly going high and it means that AMCs are continuously chasing high valued stocks. So if the market falls, there will be a huge loss for investors. I think he's basically wondering the modus operandi of sorts of mutual fund houses. So, I mean, how do you sort of explain this? Because obviously, when stocks go higher, mutual fund houses will constantly keep looking for opportunities. Do you think there's anything wrong if mutual fund houses buy stocks even when the markets are high?
I think, see, we're making an error here. I mean, the mutual fund houses are there they tell you what they're going to invest in. It is for the investors to decide asset allocation, not for the mutual fund house, right? If I do a plan and I do an asset allocation, then I know irrespective of what the market is, this much is my exposure to equity, right? Then I will need a vehicle, and for that vehicle, mutual fund is the best. No, I would be very upset if I invest in a large cap mutual fund, and because the market is high, they keep money in cash. That's not his job. If I want to keep money in cash, I will keep it outside of the mutual fund. When I invest in a large cap mutual fund, I expect that the mutual fund scheme will do what it promises to do. Invest in a large cap company, whichever it thinks is good. And I think that is how it should be. Asset allocation decision, whether to put it in equity at all, I think Mr. Sivakumar says equity is not a good thing. In which case, please don't put it in equity. Please put it in debt. Put in things like balanced advantage fund if you feel that the valuations are stretched, where the mutual fund houses have a standard formula based on which they switch between debt and equity. There are several options available. My point is the mutual fund house will not decide valuation. Mutual fund house decides what kind of investments.
Okay, Mr. Roongta, you know what? I'm afraid we are actually running a little shorter on time, so we'll have to just pause this segment right here. Thank you so much once again for joining us and answering our viewers' questions and queries as well. For now, we'll take a very short break.